So APR, yet another mortgage acronym that you'll see. APR stands for the annual percentage rate. And so APR is your interest rate plus all of the cash items that you're paying to secure that mortgage expressed as a percentage on top of the interest rate. So it's kind of confusing a little bit. APR is a formula. It almost looks like a physics formula. It's rather long and kind of complicated to understand. But the intention of APR is to help you to see what the true annual cost of your loan is. So let's say, for example, you have a 4% mortgage rate, but you're paying $5,000 in lender fees to get that 4% rate. Well, really, you're not paying 4% in that case. You're paying 4% plus $5,000. So the intention of APR is to take all of those other costs, things like mortgage insurance, lender fees, other items that are costs to you that are associated with the loan, and helping you to understand how much you're actually paying for that loan rather than just interest. So now if you have a 4% rate, you may see an APR of like 4.279 or something. Now, that doesn't mean that you're paying 4.2% in interest. You're still paying 4% in interest. It's just helping you to gauge how much in other costs expressed over that loan term. So if you have a 30-year mortgage, it's expressed over a 30-year term, how much you're truly paying. It's a good way to gauge, like I said, the temperature for that loan. So that if you have, a 4% rate, but you're paying all of this money to get the rate, and you have mortgage insurance and all of these other factors that weigh into it, and your APR is like 6%, well, then you're really not paying 4%. It's a good way to see the difference between the two, which is probably the most important piece of APR, not necessarily the number, but the gap in between your interest rate, like a 4%. If your APR is at 6, well, you've got like 2% per year in other costs that you're either paying up front, you're paying monthly, like mortgage insurance, or some combination of both. So it's really a good way to determine like how much the true cost of the loan is. So APR is a good indicator of like really what you're paying monthly. When you take into consideration all those other costs, APR can be misleading in some ways. A lot of people will focus heavily on the APR, which can sometimes be a bad thing. So the reasons why are a little bit more complex. I might explain that in another video. But basically, mortgages are very long. So you've got typically 30-year mortgage terms. So in that example, if you're paying $5,000 up front for a lower interest rate, let's say if you're buying points, which I'll explain that in another video as well, over 30 years, you're probably, by having a lower interest rate, gonna save back the $5,000. So your APR on a loan where you're buying the rate down and paying all this upfront cost for it may end up being lower than the APR if you weren't paying any cost. But that doesn't necessarily mean it's a good idea. Just because the APR is lower doesn't mean that you're going to be in the home for 30 years, you're going to be in the mortgage for 30 years, or that you should part ways with more money now to get into a lower APR because you have a lower rate, than if you were to just say, no, I don't want to pay any cost, I just want the mortgage rate that doesn't have any cost associated with it, and then that's what I'll pay monthly, especially if you're not going to be in the loan very long. So APR, a good indicator of how much you're truly paying monthly or annually for your loan. A little bit confusing on how it's computed. It's just really just a big formula. It can be a little bit misleading at times. So, a low APR is great, certainly, but you don't want to sacrifice too much cost to get a low APR. APR is not the most important thing on your loan. Your interest rate certainly is. Your upfront costs are. How long you're going to be in the mortgage is important. So it's not really the only factor there, but it is certainly something to make sure that you're watching out for whenever you go to get a mortgage. Because it's an easy way to determine how much you're really paying without actually having to compute all of the math yourself. It just turns all of those numbers into a percentage, adds it to your interest rate, so that way you get a good understanding of where you stand.